This is Mark Anthony with Mercury Time Price Analytics. Hope everybody's having a great day. Welcome to our end of day trading video for May 6th. Now what you see on the screen right now, this is the tease. We're going to get back to this chart in just a minute because this chart shows you how to catch big directional moves in S&P E-mini futures. But before we get back to this, let's talk about how we got here. So we're going to take a look at this screenshot first. And what you see on the screen is our automated algorithmic time price oscillator. And you can see that the algo triggered short today at 2874.93. Now, one of the really interesting things that our algorithm does, and I say this all the time, but I want to repeat it right now if this is the first time you're watching one of these videos. Time is more important than price. If you're familiar with WD Gann, and if you're not, please take the time to learn about WD Gann. WD Gann was a legendary technical analyst, and he understood that time is more important than price. And that's embedded into our systems because you can mathematically quantify time. And remember that time precedes price. And what I mean is, at the very first millisecond of creation, time existed. Numbers are a human construct that, depending upon who you ask, dates back about 4,000 years. So time is more important than price. And one of the things that's programmed into our algo is that the short trigger algo is designed to trigger on a bull trap. And the long algo, conversely, is designed to trigger on a bear trap. Now, I want you to look at this chart right here. Now, looking at this, would you say that the price is volatile right here? Sure, right? You get this big move down, fast move up. Volatile, right? Volatility as an absolute value is unimportant. What's important is volatility relative to the very near past. And let me explain what I mean. The VIX is the volatility measurement of the market. Let's say the VIX is at 13. And in a short period of time, because time is the key, in a short period of time, the VIX goes from 13 to 14. Well, 14 in absolute terms is a small number too, right? But if you move VIX from 13 to 14 in a short period of time, is that going to move the market? Absolutely. Because the whole thing about volatility is volatility relative to itself, the second derivative, okay? So on each bar, you've got two white dashes. And these white dashes are our proprietary volatility measurement. So for example, here you have price going sideways. And notice how tight these vol dashes are. For example, on this bar, they're meshed together. You can't even see the difference. And then as price moves, look what happens to these. They get wider, wider, and in the meat of the move, they get very wide. Then you get a consolidation, and then you get this move up. Now, as price starts to roll over, I want you to notice what happens right here. The algo triggered right in here. And this is how the system is designed to catch longs that are trapped and bulls that are trapped and bears that are trapped. You get this move up, and this looks volatile, right? Well, it does look volatile if you're just looking at these two bars. But compared to these spikes up and down, volatility relative to itself, i.e. relative to what it had been, is completely compressed. Just like this bar over here, before this move started, you had the volatility dashes, the two white lines that are on each bar. They had completely meshed. Volatility had completely collapsed relative to itself, relative to what it had been doing over here. And the same thing happens here. So you get this move up to 87, 88. You get this move down to about 65. And then you get this spike up. Now, if you've been trading the last 2 days, what has the market conditioned you to do when you get a spike up. Ride the momentum, right? Get long. Problem is, if you have price movement without an expansion of volatility, it's not going to continue in that direction. So on this bar here, look at how wide the volatility dashes are. And then they get smaller and smaller. And even though price is going up and it looks like it's volatile, right? You got to move here from 65 to about 82 in about half an hour. But even though price looked volatile, in terms of time and in terms of volatility relative to itself, it compressed. And so these folks that bought this dip and thought this was a breakout above this level right here, well, they ended up getting trapped because the algo triggered short. And those folks that were long have to liquidate positions, and then they chase it down, and that's where you get the fast move. So then we get this move back, and if you look at this whole construct here, you can see that you get your first leg down. Now what happens over here? Notice how the vol dashes get really tight again. So when we had this move up, it was a little after 1 o'clock into about 150. So again, buy the dip, right? Go with the momentum. People thinking there's a breakout here. On our Slack channel and on our live chart that our subscribers see, which looks like this is an example of our live chart. So as a subscriber, there is no software to buy. You log into Zoom, get a free Zoom account if you don't have one already. We give you a code each day, and you see all these algorithms in real time. Day trade algo, which we're looking at on the other screen, swing trade algo, and then our algo oscillators, which we're going to dig into in just a minute. But this is what our subscribers see. There is no software to buy. There is no software to download. Let's get back to this. So what I'd mentioned to our subscribers on the mic on our live chart, because you have audio in addition to just having the live screen itself, I mentioned that very high probability that this was a fake out and this was going to be another bull trap. Why? Because when you had this move from here to here, look at the vol dashes here, and then they get tighter and they get tighter, and here they completely meshed. And what that indicated is we were about to have the second leg down. So we were short up here, and I'm going to show you how we manage our trades, because we manage our trades in thirds, which means you trade a number of contracts that's a multiple of 3. Now, before I go any further, let me just say this. If you're trading E-mini futures or you're trading the micro minis, your position size is not based on the maximum amount that your broker will let you put on any given time. Professional traders only risk a very small portion of their account at any one time. So let's say, for example, your brokerage account is of the size that you could put 3 E-minis on at one time. Well, you darn sure don't trade 3 E-minis. And you shouldn't even be trading 1. Because if your brokerage account will let you put on 3 at a time and you're trading 1, you get 33% of your account at risk, right? It's not the way you do it. So if your account only would allow you to trade, say, 3 minis, you don't trade the mini. You trade a small handful of micro minis so that you never have more than 10%, 10-15% of your account at risk at any one time. That's for another video. But the point is, we caught this move early in the day. We take the trade off in thirds. So you take your first third off when you get a few handles to the good. Then you look for a place to take your middle, and then you just manage the runner. We got back in the trade short. Where was it? Right in here we were talking about. And if you were watching, I think it was on CNBC, they had Clarida from the Boston Fed on. And he made some comments and the market went down, and everybody attributed that to Clarida's comments. I didn't even have CNBC on. I was watching Bloomberg at the time. And actually, and let me just say this. If you trade for a living, don't pay attention to the TV. I mean, it's fine to have the TV on, but here's a tip, a pro tip. keep the sound off. The reason I have Bloomberg on during the day is because out of the corner of my eye, I can see the screen and see if there's a headline that may impact the market. But don't listen to these people. I mean, God bless CNBC. Nothing against CNBC, nothing against their anchors. But some of the yahoos that they have on there, look, those folks have a job. It's to tout a stock. And although they have guests who are very, very good and will tell you things for your best benefit, you also have a lot of the folks that are on those channels to tout a stock. Don't listen to them. Turn the sound off. But the point is, this had nothing to do with Clarida. W.D. Gann said time is more important than price. And you may have heard the expression, the news breaks with the cycles. Look, it didn't matter if Mr. Rogers was on CNBC at the time. This was going to break based on what the math told us, and the math told us that vol was not expanding as price was going up. Now, notice how you have a nice slow rollover in this cyan line. This is our proprietary momentum algo. If the slope is up, momentum's up. Hits an apex and turns down, momentum is now downward. But notice these kinks that you get here. You got a kink right here. That indicates that you're going lower. You got a kink right here. That means you're going lower. Now, let's take a look at the next screen. So here you can see our oscillator, our long short algo. You can see where it triggered, and over here you can see where it triggered long. Now, how do you manage the trade? Well, this is the other piece of the puzzle. The screen you saw the algorithm weaving through the chart. Well, here you have fixed pivots. And I mentioned this on last night's video. You can go a million places on the internet and find E-mini pivots for free, and they're worth what you pay for them because they're based on price. Price is relatively unimportant. It's part of the equation, but time is more important. And let me prove it to you. Every algorithmic pivot level on this chart was generated before the market opened this morning. There's a specific time in the morning to the minute that we take a snapshot of about 20 or more different algorithmic time cycles. We plug them into our computer model, and it gives us what you see on the screen, which is what we call Mercury dynamic pivots. So 90 minutes, and it's run over 90 minutes before the market opens, the day session. So over 90 minutes before the market opened, our algo told us that today's daily bull-bear pivot was 28.68.64. Now, you can see where that line runs. You think that's a pretty good bull-bear pivot? I would say so. Long above, short below, you would have done pretty well. But I want to show you some of these other levels. Trend change warning pivot, 28.74. Now, and I mentioned this on last night's video also. What is unique about our system, there may be something else on the market that exists that does what our system does. If it does exist, I have yet to see it. Because what our algorithmic pivots give us before the market opens is not only the price level for the pivot, but a descriptive name of the type of behavior to expect. So it gave us this pivot level of 28.74. And what label did it give us? Trend change warning pivot. I would say the algo is pretty smart. 28.74, trend change warning pivot. Tick point of control, which means this is where the balance of power starts to shift. 28.65. I'd say that's pretty accurate. Tick acceleration pivot. This is a level where if price is not sustained above it, you get an acceleration lower. You got an acceleration lower. We've got a series of multi-day algos. We got one here at 28.60. So you broke the multi-day short cycle here at 28.60. Then you broke the multi-day long cycle. Here's the multi-day short cycle, multi-day long cycle. Went through that like a knife through butter. Now, you have a tick acceleration pivot here. You have a price acceleration pivot here. They're both acceleration pivots, but this one is based on the tick complex. This one's based on price. What happens when this broke? Acceleration, right down and through. Now, when you get a move that goes quite a distance in order to get into one of these price acceleration pivots, it'll typically briefly stop it, as it did right here on this bar, and then it gives way. Now, here's something else that's interesting. This screenshot was taken a little after 7 p.m. Eastern time, so a little more than an hour into the Globex open. And again, if this turns some folks off, I apologize, but I'm going to say it anyway. Time and the mathematics of time prove the existence of God. People look at Fibonacci numbers and they look at things like the golden ratio. If you're not familiar with it, just Google search golden ratio. It'll show you a number sequence. There's also a sequence in time. And again, time is more important than price because time goes back to the very millisecond of creation, whereas price and numbers are a human construct. So let me prove again that time is more important than price, and that there is a master cycle in time that is every bit as important as the Fibonacci ratio, the golden ratio, whatever you want to call it. Again, everything on this screen was generated over 90 minutes before the market opened. The orange pivots are trend pivots. So here you have a back test pivot. Price comes up, it comes down to the back test pivot, and it reflexively moves higher. The trend is still intact. Then it broke. And we have different levels. So this orange algo here is just a deeper cycle, a longer cycle of trend pivot. So your high today was up close to 28.90, the overnight high. And in Globex, you came down and stopped at 22.23. This pivot level is 28, 23, 30. Now, the algorithm puts out 2 decimals. I know the E-mini doesn't trade 30 cents. But this pivot level that was put out this morning over 90 minutes before the market opened gave us the Globex low on a move that was almost 70 handles. Almost 70 handles, and it stops to within 1 tick of a level that we published for our subscribers 90 minutes before the market opened. Now, you can pay thousands of dollars for a trading software program. And although they may give you a trial period, after a period of time, if you don't like it or it doesn't work for you, they're not giving your money back. There is no software to buy here. You pay a subscription. We bill every 2 weeks, so you're not even committed to a month. You try our systems out, you don't like it, 2 weeks, you're done. No commitments, right? Now, just to give you an idea of the way we run our business, even though we don't even commit you to any more than 2 weeks at a time, because there are no contracts, you're not even paying monthly. On the other end, we give you a lifetime rate lock. That's just the way we run our business, okay? So let's move on to the next screen. Now, this is what we talked about in the beginning. Algorithmic time price oscillators. When you get a cluster of intermediate cycle oscillators, and this dashed white one, this is the key day trading cycle. This dashed white line is the shortest, in terms of time, the shortest oscillator. And then going from shortest, progressively longer, the next one in terms of time is the solid white one, and then the dotted white one, because these all share a mathematical relationship. The orange ones are trend oscillators, based on time. The purple ones are acceleration pivots, just like the color coding from the previous chart. Now, I don't want to get into the mechanics of the acceleration pivots and the trend pivots or oscillators, but the point is this. When you get a cluster of these intermediate term time price oscillators, whichever direction they break, up or down, you're going to get a fast move. Here's your cluster of time price oscillators. Boom. Now, this works in both directions. So this is today. Let's take a look at the last 2 days. Wrong screen. So I want to put all the bubbles on it. All right. So this is today. Cluster of algorithmic time price oscillators. It releases from that cluster. Boom, you go lower. But what about over here? Now, let me ask you a question. Does this look like a cluster in terms of price? Sure. Congestion zone, right? Next question. Does this look like a cluster of price? Well, we had a reversal on these two bars. There is no cluster of price here, but yet you've got a cluster of 3 of our time price oscillators, and the weighting on these is way tilted to time, not price. So you can look at this and say, well, this was just, price broke from a price congestion zone. Sure it did. Didn't break from a price congestion zone here. You had a sharp move higher because it found support at this cluster of oscillators. And then when you had this move up, you had a cluster of 4. Here you had a cluster of 3 of them. Here you have a cluster of 4 of them. And then you get this. And then you get this cluster here. It comes down to the next oscillator, finds support, and boom, you get a move. So the point is this. When you get a cluster of these intermediate term time price oscillators, doesn't matter which direction they break. You ride that direction. And the theme for tonight, the reason I started out with a screenshot of the oscillator cluster that broke today, is that the big money in trading futures isn't, this hyper trading in and out nonsense. I mean, you can make money that way. You can also drive yourself nuts, and one bad trade that you get stubborn in wipes out a couple of days' work. The way you make the really good money as a professional trader, number one, you have to manage your risk. It goes back to what I mentioned earlier. You never risk more than a small percentage of your account on any trade. But what our systems do, among other things, is they let you know when you're getting these very tight compression of the relationship between time and price. In whatever direction it releases, boom. So let's say, for example, you were short here, and it comes down in here to this cluster and it breaks. Well, it's fine to be short until you see support at this oscillator. And when it comes back into this one and doesn't reflexively go back lower, well, you better not be short right here, because then you get stubborn short and boom. So I just wanted to show you both of these charts, because here you see this break today. And this isn't just about a congestion zone of price that broke. I mean, yes, you can make that point here. But this proves the point that it has nothing to do with clusters of price. It's clusters of time price oscillators. And that is what is unique about our system. And I guarantee you, if a major company had a system that does what ours does, you don't even want to know what they would charge you. And if you go to our website, mercurysignals.com, you're going to be pleasantly surprised what the subscription rate is for our system. But you can buy software that costs thousands of dollars, and use all the different canned trading systems that come with your brokerage platform. There is nothing that does what this does. And we will never reveal it. We'll never put it into a software program. We will never sell it to an institution. We will never publish it in book form, ever, period. So if you want access to these systems, there is only one way to get them, and that is through our subscription. Did I have another chart? No, I think that was it. So one other thing I wanted to show you before we break, let's go back to the live chart. These Mercury bands, these are calculated based on the end of day session data. And we run this algorithm. This is different from the one we run in the morning because this gives us wider levels. And what these Mercury bands do is they seek out very high volume areas on the chart because those are areas to which price will be magnetized, and those are areas that will form key support and resistance. So you came down into this Mercury band here at 25, and you stopped at 23. And then it found support, this bar, and then boom. And this is what we showed you earlier. You get about a 70 handle move down that stops within one tick of the swing trend pivot that we published this morning before the market opened. So we certainly hope that you'll check out our website. It's mercurysignals.com. We've got a special rate that's running right now. It runs until May 15th, and then prices are going up. The price that we're offering between now and May 15th is by far the lowest price that we've ever offered. And the reason we're offering such a low rate is I know this market is tough. And I know that look, even with our systems, I'll be completely frank with you, it's a tough market to trade. And it can get very challenging even with the systems that we have. The point is this: I have no idea how anybody could trade these markets without the kind of algorithmic metrics that we offer. I wouldn't even want to try. The other reason we're offering such a low price right now is we understand that things are very difficult for folks with COVID-19 and with the shutdown in the economy. And we understand that folks, for the most part, don't have a lot of extra money. So we want to give you an opportunity that possibly we can help you and help your family without committing a lot of money. So I think the rate right now for 2 weeks, I think it's $114. I know from a marketing perspective, you're not supposed to give that away. You want people to go to the website. But you can try out our system for 2 weeks. I think it's $114. Check out the website. Just click the subscription tab. So if you trade the E-mini for the price of one E-mini handle a week, approximately, a little bit more than that, a little over $50 a week, you get what we believe is the most sophisticated consumer E-mini trading platform that exists. And so we hope you'll check it out. Most importantly, God bless you, God bless your family. And let me close with the most important part. Times are difficult. God will never leave you nor forsake you. And regardless of what you get out of this video, understand that God loves you and He is there for you. And all you have to do is call out for Him. So with that, we wish you the best. We thank you for your time. God bless you, God bless your family, and we hope to see you again soon.